You are listening to an entertainment program put together by a company called Financial Ineptitude. Anything said on this show is not an endorsement or professional advice. Would you really want to tell a court of law you were suing us because you thought taking financial advice from two idiots on a podcast put out by Financial Ineptitude was a good idea? Really? Clown hat smiley face.
Well, hello and welcome, everybody. Get your asses inside. We have another thrilling, exciting interview queued up for you today. I'm Shopkeeper Dan. With me, as always, is Kyle, creator of financialineptitude.com. How you doing today, Kyle?
I'm doing all right. I'm a little sore. Second week of mowing my own lawn has not been fun.
Oh, and I take it you don't have a ride-on mower?
No, it is self-propelled, but that doesn't seem to make much difference.
Yeah.
Also, my wife decided to chop down every single hedge, so I had to clear all the debris out before I could even mow this morning.
The joys of home ownership. You don't even have any kids to make them do the yard work.
Like they would.
Look, they would.
Kids these days.
Anyway, folks, we're so excited you're joining us today because we got here in the shop none other than Dr. Bruce Liu. How are you doing today, Dr. Bruce?
I'm doing all right. Hi, guys. Thank you for having me here. Good to be here.
Where are you located, Bruce? Are you in Shanghai or Beijing?
I'm supposed to be in New York City, but I came back to China and last September. And thanks to COVID here, I got stuck in Beijing. So right now I'm in Beijing.
Oh man, how long have you? When were you supposed to come back?
Well, my plan was going back to New York City at the end of the first quarter, and now things are getting tricky here, and a lot of things going on. I'm thinking might just stay a little bit longer. Well, all of a sudden, COVID hit Beijing as well. It's getting worse.
Doesn't sound like you have much choice.
No, not at all. And hopefully, I can get back. The end of summer. That's my new plan. Fingers crossed, guys.
You think it'll be that long?
Well, a lot of things going on here. I have zero conviction how this gonna end. So I don't know. Let's see how this goes.
Because I think that's one of the things when China did their first lockdowns, they were pretty heavy and hard with what they did, but it seemed like they were able to loosen the restrictions sooner because they were so aggressive initially. Well,
the rumor says, and not rumor, actually, they issued a report this weekend. Shanghai is opening up gradually in the middle of this month. Well, a lot of debates, how serious they are opening up and how gradual, it could be. We just don't know. But in Beijing, it's actually getting more serious.
Really?
And half of the city is you have to stay home. It's a semi-lockdown. You're not allowed to go to work and just stay at home. That's the message. Stay at home. Don't get into troubles. But the good thing is, you probably have heard or saw, seeing the videos and pictures, people in Shanghai, they couldn't get the food, at the very beginning of the lockdown.
Mm-hmm.
That was not the case so far here yet. We got enough supply. I'm not worried about that. And so that's the good side of the whole situation.
Yeah. So you should be safe then.
Yeah. Fingers crossed.
Well, Bruce, why don't you tell us a little bit about Esoterica Capital? You started that in 2019?
Yeah, okay. Yes, the beginning of 2019, I left the firm, the hedge fund, my previous hedge fund, got a chance to do something new. And then, with the partners I have right now, and we thought because at that time we saw this, the digital economy 5G cycle just getting started. Let's just work on that. And back then we thought about doing another hedge fund, but then we figured out the more exciting thing to do is actually more focusing on the retail investors. And for retail investors, ETF is the best, the instrument. Mm-hmm. And we actually get a little inspired by Kathy's, arc. To be honest with you.
Poor Kathy.
Doing great now.
I have to be very honest with you guys on that one. Yeah, but I figured that's a good way to, really help the retail investors, help them to invest, the growth, the same themes, and the ETF is the way to go. So we set up Esoterica Capital, really focus on the ETF products, and spend a year, getting the infrastructure ready. We have our own trust and getting, all the service providers in line. And fortunately, March 2020, we took advantage of the bottom of the market, launched the product.
Oh,
so it's been a little bit more than 2 years.
That sounds like an excellent time to jump in.
Yeah, wow.
Was that just luck or was that planned?
Oh, actually, that's a good story to tell. We were going to launch at the end of February, but we saw things are getting ugly, and we have our own market cycle indicators. We keep using those tools because we do use top-down macro view to help our investment process. We did see that coming, so we want to be conservative. We wait until the middle of March. If you guys remember, Fed just threw out all the tools they can leverage within 2 weeks, a time frame. And after that, we felt like this is time to get in. And we pulled the trigger. And fortunately, I think that's a great. You're right. That's a great time to launch the fund.
Yeah, should make your 21 number or 2020 and 21 numbers look really good.
Yeah, 2020 we did great, almost 100%. I was more proud, what we did last year. Last year was tough for growth managers. If you can remember,
yeah, we
can still put up very healthy numbers, 20+ percent. So that's last year. This year is even tougher.
Right. I think this year is going to be tough for everybody, though.
Yeah, especially for growth managers. You're just it's precisely just killing everything you do. But we'll get through this. It's been almost half a year. It started in November. Yeah.
It should mean a lot of things go on sale for you, though, too, right?
Yeah, it's just man, this is a decade. It feels through so much. Yeah, but it's I like it. It's a challenge. That's where you grow your muscles. Yeah, you can just get better.
The fund that you launched is symbol WUGI. WUGI.
Yeah,
is that
WUGI?
The pronunciation?
Yeah, that's how you speak 5G in Chinese.
Oh, okay.
People call it WUGI. If you say WUGI in Asia, a lot of people know what you mean.
That makes sense. All right.
Yeah.
Why is 5G such a big deal then? I see a lot of people talking about it, but the switch from 3G to 4G didn't really seem to be all that life changing.
Yeah, you're right. Probably I need to explain this a little bit. We use 5G is to describe the whole cycle. 4G is mobile internet, right? So people happen to say this is 4G cycle, and the next 10 years, maybe 15 years, that's be 5G cycle. It's not only about the 5G technology itself. It's a lot about all the things it enables.
Okay.
Put the cloud together, low latency. You now you get edge computing. You got new applications. It's the whole package rather than just 5G. Yeah, that's where we are coming from, at least.
All right, that makes sense. So, what are some of the companies that are in the holdings of the fund?
Right now, well, to be honest with you, right now the largest holding is cash.
Oh, smart.
Yeah, well, we took advantage of the March. Market came back a little bit. Toward the end of March, we cut some. As an ETF fund, I'm allowed to hold as much as 20% cash. Right now, we have close to 20. I think that's the right thing I did. At least I feel good for all the investors. We saw this is the end of cycle. I need to be conservative and having some dry powder on the sideline, and to hopefully buy the dips later on. And we balanced the exposure. We moved towards the large cap. If you saw the largest holdings, now we got AMD. That's the name we really like, and high convictions. We got Microsoft. We got Marvell, Qualcomm, and TSMC, NVIDIA. All those. We did move the portfolio more towards large cap, high quality growth. I think that's where you should, at this point of time, that's where you should hold your portfolio at. The assumption is, even we get a recession, this is a name I feel very comfortable to hold through.
Right.
Yeah.
That makes sense. AMD is something that we've followed for quite some time. What do you like so much about it? Like, what makes you want to be the investor?
Okay, that's a lot of things to talk about, like AMD. We like Lisa Su a lot like a respect to her.
Mm-hmm.
She saved the company. We follow the company
Right.
since she took over the CEO role. She has done everything right, and nothing spectacular. She doesn't do anything magical. We call it a boring execution. She just has been executing so well, and de-risk the company at the very beginning, pay down all the debts and having the new roadmap, just execute. And the products just getting better, and also collaborate, dump the Global Foundry and collaborate with TSMC. That's a brilliant move that helps hugely on the quality of their products. Now, AMD is gradually becoming a platform, a portfolio play. It's not just like a single product. Of course, now everything is all about like how they gaining the market share in data center, cloud server market. That's the whole thesis is all about. And this is just, again, they're executing so well. In the last quarter, they even revised up the growth, Even this environment, that's just not an easy thing to do. And so much, visibility is so good. And they, voluntarily to de-risk the weakness in PC. And so I think Lisa Su has been managing the company, fantastically. We just love everything they do. And this is just the start of, the whole journey. And they have a long journey, ahead. As long as, semiconductor is eating the whole world. That's our motto. Not software anymore. Semi is coming to the play.
Really? So you're like software as a service, you think is on the decline?
No. Don't get me wrong. And
I didn't think so. I was gonna. Do I need to dump my Salesforce? Is that no?
two major like investment thesis in our portfolio. One is semiconductors. It's because you have this secular growth because the semi content is increasing everywhere, right? Thanks to cloud, thanks to AI, thanks to big data, everything comes down to computing. Computing needs what? Needs semi. Another pillar is just this, SaaS, software as a services, and people are moving, their workload to cloud, and on top of the cloud, infrastructure. You build all kinds of, softwares, infrastructure layers, application layers, and that's another revolution where we have been going through. And the companies, you are familiar with the old generation, Salesforce, SAP, Adobe, we like new ones.
Oh, really?
Old ones are good, still good. Don't get me wrong, they're very, high quality place. ServiceNow, Workdays, but we like the exciting place. Although, in the past like 6 months, the valuation part, the multiples got just,
right.
Destroyed. That's a macro like a factor. It's because the interest rates is rising, and it's killing the the multiples. But the fundamentals, take a Datadog for example, and it keeps growing at a very, very high speed. And security layers, all the security names, let's forget the stock price for a minute, for a second.
Right.
Their underlying business are still keep growing very well. And even the old boys like Microsoft, we like Microsoft so much because they keep reinventing themselves. And every layer on the SaaS, this SaaS game, and you can find the influence, the impact, and the dominance of Microsoft.
Right.
They have been doing so well. Who else? Snowflake. You guys probably know that as well. Expensive, yes, but underlying business, the momentum is still there, and keep growing. The downside is, they're still quite an expensive stock, so you have to be a little bit more careful.
That's one of the reasons why I've always liked Salesforce, because it's put up like 15%, 20% growth every year. It seems like, and they've been doing that for what, nearly a decade at least.
Yeah, exactly. I think although, that's how you gauge, how you judge, a good, SaaS company. You have to be able to keep up, keep growing like that. That's, and also at the same time growing your margins. You have to have like two cylinders, to justify the valuation people give you.
Going back to AMD for a minute, do you have any? What's your feelings on Intel? Do you think Intel will be able to stem the bleeding? Because you mentioned the AMD taking server share, and that's something that Dan and I have been looking at since we started doing this podcast. Was AMD eating into that lead? Intel doesn't seem like one to stay down for too long, and AMD and Intel over the history of the two companies seem like they kind of always flip-flopped over who provided the better product for the cost. Do you see that cycle continuing, or do you think AMD is just a clear leader at this point?
Two companies, two companies go way back. If you guys remember back in before 2008, right? That was a long time back. And at the one point, AMD. Sorry, I'm telling you guys a very interesting story. It might take a little bit.
No, that's fine. Please.
Back then, AMD had a similar momentum, just like they have right now, and good products, decent products, but a much cheaper price, and getting the market share from Intel. But when Intel decided to kill their momentum, Intel lowered the price. So at the same time, kind of like AMD messed it up. They didn't use like a TSMC back then. They used the other like a foundry, and they don't have the real like the technology, the manufacturing process to really support the product AMD wanted to have. So like AMD, after that, AMD almost went bankrupt and really got into troubles. So when this time around, when Lisa Su took over the CEO role, AMD coming back with excellent products, gaining, market shares, and people were suspicious. Are they gonna repeat, that failure again?
Right.
And also Intel is gonna just kill them like what they did last time. This time is actually different. Like two things. First of all, AMD has been, like we mentioned earlier, has been executing really well and high quality products. They are not just focusing on the low end anymore. It used to be just they compete at the same level, the same quality of products, but the cheaper price. This time around, they have actually better quality, product out there, and that's really thanks to the foundry process, provided by TSMC. Two companies really collaborating really well. Of course, AMD has their own redesigned the architecture for their chips.
Right.
Two things together that's really make them stand out. At the same time, the success of AMD also relies on kind of like Intel messes up, mostly messes up their manufacturing process. Even now, that's where their trouble is. Right? They try to fix it. They keep delaying it. Now the whole story is by 2025, they think Intel is gonna catching up. Is gonna catching up with the TSMC manufacturing process. That's the biggest bet Intel is having right now. They almost bet on everything on that. If they mess it up, I think they're gone.
Wow.
So this is, that's in our opinions. And this is not looking good, to be honest with you, even now. They're just telling the investors, the community, a story. You just cannot, prove they're wrong. You have to wait until 2025, say if they can make it, break it. If they could.
I would want to bet against them personally. They still have really good architecture, like the designs, like even their 11 nanometer chips, I think is what they were on when AMD was releasing the 7s. We're still on par.
The problem is more with their manufacturing process,
Right.
That's something they have to fix. And the new CEO is really, really, I think has done his best.
Yeah.
And using all the resources, even make this a political weapon, if you know what I mean.
Right, trying to bring the manufacturing back to the States.
And get all the fundings from the States and from all the governments around the world. Basically, that's himself said that,
But didn't Microsoft also work out some sort of deal with TSMC?
Well, when you see Microsoft is, all all the hyperscalers, the cloud vendors, they all try to, make their own chips, customize their own chips, so to support their workload. Actually, Amazon did the most.
Oh, really?
Amazon did the most. Yeah, Amazon is, I think, almost I forgot the number, so I have to really talk to our semi-analyst. But a very significant part of their workload is actually run on Amazon's own chips. And this is the trend. All the big boys in the cloud, they try to customize their own, build their own chips and the GPU, CPU. Yeah.
That makes sense because Amazon's got really big data centers, Microsoft. So it makes sense if you were running your own data center that you'd want to have your own product that you can put in there.
Vertical integration.
That way you can run your workload more. You can optimize your workload, from the hardware, from the chip level to the software level. That's what's going on in this,
It's amazing.
Yeah. That's how things are getting so powerful. That's also another reason we like Marvell. Marvell is actually the guy who can help, all those boys and companies to do their customized, chips.
Oh, is that different than the Marvel Universe, the movies?
Yeah.
Okay,
Disney owns
said
them.
that. I was like, wait a minute, is he talking about?
Disney owns them.
Okay, that makes more sense. So is that sort of like the Xilinx acquisition that AMD made? Like you're talking about the configurable chips?
No, it's not like that. It's they just help hyperscalers customize their own chips. Now like FPGA, that's a different product.
Okay,
it's more like ASICs and also ARM based stuff.
I was looking through your website on Esoterica and noticed all the resources that you offer. There's a whole bunch of white papers. There's libraries. You do monthly investment letters. Oh, I was just wondering if you could speak to some of the things that you guys post on there and why you do it.
Well, mentioned earlier, we want to serve retail investors, and having the a good high quality product is just part of the equation. And you have to do the proper investor education. That's how you build the trust. And by the way, the team here is really into research, and I think that's our DNA. So we try our best, just sharing what we have learned in the process, how we think about the market, from both the top down and bottom up. Because this we analyze companies, is particular growth companies, but at the same time, that's one thing I think we're very differentiated from other growth managers. We pay a lot of attention to the global macro as well, and because two things really go together. And you have to manage both the process. So, then we just try our best and sharing our thoughts. And we post as much as we can.
I was reading through your monthly investment letter. One of the things from the most recent one in April, you mentioned I think the headline, the title here is "The Fed has a neutral rate problem." Could you speak more to what that means?
Okay.
Because they don't seem like they're neutral. It seems like they're increasing.
So first of all, a neutral rate. So that's it. It actually it means something. That's the policy rate. Fed thinks, and it's neither accommodative nor restrictive.
Okay.
That's what that means. That's where Fed wants to go. That's the right interest rate we should be able to have. And now it feels to us, in that monthly letter, it's a little bit too technical sometimes. And so we share some charts, and that helps people to understand what that means. But at the end of the day, Fed has their dot plot, and there's a longer run dot plot. That's where Fed thinks neutral rate should be. And the market also has their market implied neutral rate. That's just how market is pricing in this. Historically speaking, and the market is just using Fed's guidance, that dot plot, longer run neutral rate, as a guidance, as an anchor, and never really seriously challenge it. But this time around, and the market, especially coming into April, the one we got bad inflation prints, and the one people like James Bullard and John Williams came to the market telling people, okay, we need to do more.
Right.
We need to do 75 bips hikes. Although later on, our chairman dismissed it, but that did scare the market, and market were not sure. And if they should follow the Fed's guidance, and if even the Fed knows where the neutral rate is, if that possible, actually that's even now I think people, that's a back and forth. That's where the in our mind, that's the biggest risk we have, in the market so far. Market starts to challenge the Fed. If you look at this market implied neutral rate. It's technically speaking, that's the OIS 5-year forward. It has gone beyond what the Fed has guided, and that's really spooked the market. Why the April we felt so miserably because because of that, the rates market have been challenging this assumption, and you see the rates market has huge volatilities, and we have a long belief, interest rate, especially neutral rate, is the anchor to the valuation. Is the anchor, really the anchor to the valuation of all the risky assets, credit, or equities, commodities. So when your anchor is volatile, is up and down so much, that volatility got spilled over and amplified. So that's why what we saw. In April, even into the first 2 weeks of May. And I think that's what's going on in the market space. We have to wait until, market either feel comfortable with this neutral rate assumption provided by the Fed, or maybe you don't get surprised. In June, Fed might has to adjust up their, neutral rate assumption. If you look at the blog, this I actually mentioned that in the monthly letter, Neil Kashkari, right? And he used to be the dovish person on the committee. He started challenging his own estimate of a neutral rate.
Oh,
to me, that scares the market, right?
What?
Yeah, that's not good.
No, look at his blog on the on their website, and so. I think that in the grand scheme of things, that's what's going on. That's why April, even in the first 2 weeks of May, we felt so miserable.
How much faith do you think people still have that the Fed knows what they're doing after spending a year calling inflation transitory?
I know. And they made a mistake last year. And, to their credit, they realized the problem, I think that's after September, the fourth quarter, I think, in that last year. They realize this, especially when they say this, ECI index really, accelerating. And the Fed realized that they made a mistake. They tried to fix it quickly. They did, actually. And that's why they were so aggressive since the November. And the market has responded, right? Because all the growth names started rolling over last November. And this year, coming into January, they accelerated. They became even more aggressive. I don't think a lot of people were saying, "Oh, Fed is so behind the curve." I don't think so. I think Fed has caught up, and things just took time to work out. But still, given what's going on in Ukraine, Russia, and given even China throw that into the equation, and you just don't have visibility. There isn't. And so you have the Fed is playing this game too. They tighten. Let's see how that goes. If they tighten too much, which is good, they control the inflation. Everybody is talking about the soft landing. like there's no point of talking about a soft landing. They just keep, Fed made it so clear. Inflation is the top priority.
Yes.
They're going to keep pricing on it and, try to control it and hiking until they feel comfortable, inflation is under control. If we were lucky before, inflation really, got under control before, we got hit a recession, we're lucky. We got a soft landing. Or, we just, we're going to go to a hard landing for sure, It's just a matter of luck, how lucky we are. But I think, we should be prepared and we're going to run into a recession.
So you don't think that they waited too long to act aggressively?
They waited a bit long, but I think after that, they did pretty well. They ramp up the hiking, be as aggressive they can. And now I don't think they are behind the curve anymore. We actually, if you look at our March newsletter, we tried to argue that Fed is no longer behind the curve.
I do like what else you said too. The Fed has blunt weapons, not surgical tools.
Yeah.
No. So why bother, right? Talking about soft landing or not? Even Jay Paul, right? Last Friday, he came out. Even he said he's not sure we're gonna get a soft landing or not. It really depends, Depends on how inflation is, how quickly we can control the inflation. Yeah. But one thing I want to point out though, this time around, our economy, the households, the corporates, are really healthy, and we have to admit that. And the labor market is insanely healthy and too healthy, So it wouldn't hurt to let the labor market cool down a little bit.
That makes sense. Why I saw the article saying that B of A analysts were saying that Powell wants basically a corporate hiring freeze.
That's true. Amazon start finally, if you follow Amazon's earnings, they stopped hiring because last 2 years they spent so much money hiring everybody, building their logistic infrastructure, which is a good thing, but they have done too much. Now it's a good sign, they stop hiring, and in my wildest dream, this time around, and the Fed is being so aggressive, they're gonna make Europe, make China, all the emerging market get into a recession, but the U.S. should be fine.
You don't think we're going to have a recession, at least this year?
Even we have one, it's going to be a very, very minor one. Even we have one, it's going to be a very minor one, just because the underlying strength is there. It's for real. Yeah.
Because we did have the latest GDP numbers were...
That's a misunderstanding by the market,
Okay.
No, the underlying is it's trade. It's trade, and it's the inventory parts. Making this, GDP growth looks really bad and negative. But all the consumptions, the things that really matter, consumptions, business investment, they look insanely, very, very healthy. I'm not worried at all. If you look at we actually analyzed GDP report really thoroughly, because although that's backward looking, but that really can tell you a lot of information. And you can really see this shift from the goods to services, and from a different angle. I'm actually very happy with the GDP report. It tells everything about the where we are at this moment. Yeah.
You're not worried about the supply chains staying slow, affecting the growth going forward?
If anything, supply chain issues, that's not affecting our growth that much. That has much bigger impact on the inflation part. I actually would like to, I would like our growth to slow down a bit more and let the supply and demand become more balanced and to help on the inflation problem. If anything, at this point, given QQQ has been done QQQ has priced in a recession already, right? And so I would like to have a minor recession to make everything reset. You smooth out everything, and we go back on the right track. I don't like what we have right now. You just feel like you're so twisted. It's not working smoothly. For whatever reasons, now we need a recession to a certain extent to sort things out. Then we get back onto much healthy growth track.
Yeah, I mean, if you look at the charts, I don't know how into technical analysis you are, but just looking at the explosion from after those lows in March 2020 and how much we've risen up without a real significant pullback. I mean, this is the first significant pullback from those highs.
Yeah.
But it definitely feels scary. The way they were selling off over the last week and a half has looked pretty frightening.
It is, we, especially for growth manager like ourselves, because a lot of like SaaS names, for example, I believe like some people, we didn't do that analysis, but some of our friends did. I think on average, like, no matter you're a very good quality, high quality company or not, your stock like down more than like 50%.
Right.
Yeah. In the SaaS space. So that's how severe this, correction has been.
Yeah. Growth has, and it's really weird the way the markets have been lately, where it seems like there's 5 or 6 names that are holding up each main index. So like the SPY may only be down, 20% or so from the highs, or 25 or whatever it is. But like went over like half the companies are down more than 50% from their highs too. That make that up. That doesn't make sense.
we started with the rotation, kind of like you rotate out of like growth into value, right? That was the first quarter. That's the theme. I think we gradually, we get into the second stage of this thing, capitulation. And I'm actually waiting for the value stocks, to drop. I think that's what the whole market is waiting for.
Yes.
And once they started like capitulate,
then we can finally get some buying.
Yeah, we see the real bottom of the market, and hopefully by then, the inflation is also under control. That's where my if you have to ask me today, I'm really looking at the second half of this year. I think we are gonna see the bottom of the true bottom of the whole market, and hopefully inflation is also back, back under control, and the Fed doesn't have to be as aggressive as they are today, and because the market has priced in very, very aggressive Fed.
Right.
If there's any sign, Fed doesn't have to be that aggressive, we're gonna get a very healthy, rally. That's where the new cycle starts.
Very true. What about with the qualitative easing, or what's the one for the actual reduction of the assets? Tightening.
Balance sheet reduction. Yeah.
I mean, with as much money as they pumped into the market since 2008, I think the 2008, 2009.
Yeah.
If they start pulling that out, what sort of effect do you think that's going to have on the markets?
First of all, put things into perspective. Fed has only done that once, right? Last like a cycle. I believe like they started like 2018 and did it until like 2019. Then we ran into this, if you still remember, repo market crisis.
Yes.
And that's equity guys may not like pay attention, but if you're a rich guy, you're in the credit market. So like I forgot, like September or October 2019, we ran into that problem. That's mainly because of like the QT. They had done that, too aggressively, and the Fed realized the problem. They stopped the QT and they fixed the problem. So that's the only time they done that. So this time around, they changed their like strategy a little bit. First of all, they became more aggressive. Second, they started doing this a lot earlier than last time. And they have done some research and claiming this is good for like, keep the curve, treasury curve like most steeper. And which because nobody likes a flattening curve, right? But that's all research. We just don't know.
That's just a straight line.
Yeah, we just don't know how this is going to work out, and so that's why the Fed is going to be very. I think they're going to be very careful and see how that goes. And I'll be very surprised that they just they're gonna just push very bluntly in terms of the QT.
Have they said if they're going to be actively reducing the balance sheet, or are they just letting assets expire?
so far, the message we have heard, like from the latest FOMC meeting, actually on the treasury part, they are not going to actively selling. But for the MBS and the mortgage-backed security portfolio, I don't think I think they still keep that option open. That's my takeaway. But let's leave that to later because we don't know.
Well, you can speculate all you want. As soon as the next meeting comes around, it could all change.
Yeah.
But it's fun to speculate.
Yeah.
And if you're right, then you can point to this recording and tell all your friends about how smart you are.
Right.
But the tricky thing is here. I think there's some misunderstanding there, guys. A lot of people, when you're talking about the QT, a lot of people, there is implication on the asset side of the Fed's balance sheet. But if people have done a lot of research, it's really about the liability side of the central bank's balance sheet that actually matters for the risky market. The guy from Citigroup and Matt King, I like his research a lot, and he has had a very interesting take on that. It's this reserves. It's really the size of the reserves or the marginal change of the reserves is going to has been affecting the equity returns. Actually we mentioned that in our April monthly letter at the last section. We now also have a new framework. I call it a quantity factor. And but it's not only QT has an impact on that one. It's also many other factors. How much money like a treasury is going to leave on a Fed's balance sheet. It's how all the money market fund how they're gonna use this reverse repo facility at the central bank. All those things are gonna have impact on the change of this reserve, and so it becomes actually very tricky thing. It's not only about QT. So that's the the message I'm trying to give to the audience. It's not only about QT. Actually, treasuries has a much bigger role to play to decide how this quantity factor is going to affect the equity returns. So let's see. Next time, hopefully, next month, you guys can see our monthly letter.
Right.
And we're gonna keep following that. Yeah.
And that's on the Esoterica Capital website?
Yep, under the resources.
Yes, it is.
It sounds like you spend most of your time doing fundamental analysis on macroeconomic environments.
Well, we do. Yeah, here we got a team of 6. Actually, we have 6 analysts, myself included. I'm the portfolio manager, but I'm more coming from the top-down approach. I pay more attention to the macro themes and risk premium and which part of the market you would like to take risk. And other analysts are more focusing on different sectors, semiconductors, software, internet, so on and so forth. So that's how we that's our investment process.
I'm looking at the other people because I think we were looking at maybe scheduling something for the. Who is it? Wei Wang, I think, is the one who does the focus on semiconductors.
Yang is the one is focusing. Some of our new analysts are, you don't see them on our website yet. We need to update that.
I notice here you have a chief scientist of artificial intelligence and big data.
Oh yeah.
Oh, that's we use that's an old project we used to have. We try to incorporate that, but unfortunately, we stopped that project. That's too much burden for a small shop like us.
Okay.
It needs much more investment than what we can afford at this point. So now that's we kind of stop that. Hopefully, if we grow bigger, we bring that back.
We're always excited about learning about AI and how people are trying to incorporate it into market strategies or investment strategies.
I know we tried that, at the beginning of this whole thing, we really try to use AI and big data to figure out, the whole semi supply chain, and hopefully we can, try to. That's how we approach it. But to be honest with you guys, data is so expensive. and also, you pay big bucks on those things, and you are not sure if you can get anything out of it. So,
oh, that's right.
Yeah, we have done. We tried a couple of months, and then later, we realized this is too much for us to carry on. So we kind of like stopped it. Let's see. Hopefully, going forward, we get another chance.
You mentioned a few different times that you're striving to help the retail crowd, the smaller investor. Like, what are some of the things that you wish retail investors knew? Like, if you could put out material that that everyone would read who wants to be an investor, what would you give them?
That's actually very good questions. Actually, if in our library, we try to lay out some very fundamental like techniques or tools retail investors can use. Like, for example, having a portfolio perspective rather than just trading stocks, right? And you do your own asset allocation. And, I know a lot of people started like dissing like a 60-40 portfolio. And, but I still believe, for any retail investors, they should start with asset allocation framework rather than just, really getting into picking stocks. I think in long run, that goes a long way. Then just keep learning all the basic stuff. And I don't think investment, is hard, but I think that's a skill everybody has to have going forward. Very few people have like DB plans these days, right? So you have to manage your own retirement funds.
Right.
I used to manage like Dow Chemical's, DB plans.
Wow, that's a big fund.
It is. And I don't think younger generations, especially, most of corporates don't offer that benefits anymore.
Not really, no.
So the most you have is 401k, but still you need to manage your own investments. So start learning all the basics, and this is not like you don't need a fancy stuff. You don't need a Ph.D. You don't even need an MBA for this, right? But just stick to the basics, and I think that's gonna be very helpful. And keep it simple. That's another thing. Keep it simple. Those are the things that when at least I'm writing stuff, I try to think from their perspective. If they can understand this, and they can at least they don't need to become like market experts, but at least they get the gist of the whole thing, and feel comfortable using our products. And to be honest with you, I think for most retail investors, they should stay away from picking stocks.
Right.
Leveraging the ETF. Those are the very helpful tools. Just buy the QQQ, buy the SPY. I think they don't have to buy WGI, but I'll appreciate it if they buy. But if you know what I mean,
Dad and I have said for years too. We after almost 2 years of doing this, finally realized like how much work is actually in it. So anytime somebody asks us, or like they want to get into it, it's like just buy the SPY.
Exactly.
Buy the SPY and then learn.
Yeah, I tell them to pick an industry they think is going to be around in 10 to 20 years and find an ETF for that one.
Yeah. Also, that's something people in this country, I mean, in the United States, they didn't realize how lucky they are. They have such a very, very healthy financial market. Because U.S. market is probably the only one market that delivers like a very healthy, risk premium, which means if you take risk, you get paid.
Right.
So buy and hold actually works. This is not true for many other countries, many other markets. Emerging markets like China, even Taiwan, even Japanese markets. Yeah, that doesn't work that way because they don't have a very healthy, their equity markets don't have this much risk premium. So if those are the only options you have. You have to trade a little bit. You have to time in the market a little bit. Otherwise, you get screwed. Buy and hold doesn't work for them. But people here are so lucky. They don't realize how lucky they are.
That's because the one area we are lacking is an education in that. You think that in high school they do some sort of financial education, but there's just nothing. Is that something they do over in Asia?
Well, when I was I did my high school back in Asia, so I didn't learn that either. So,
So that's kind of a common theme.
It is a common thing. I think investment education is lacking everywhere, and
yes,
but that's good. People like us, we want to do more. We should do more, and I think we are doing the right thing.
For sure.
Yes.
I really like what you guys are doing. The more I've looked through your website, the more impressed I've been.
Thank you. I appreciate that. Hopefully, we get more resources, we grow bigger, we can do more.
Dan, do you have anything else you want to ask? I think we're starting to run up on our time here.
No, this has been fantastic. I really, really have enjoyed your insights into the economies and the markets.
Thank you very much, guys, and I appreciate that. Hopefully, this is can be helpful for your audience as well.
Okay. I think so. Where can the people find you?
Well, come to our website, and and also come to our LinkedIn, and we posted our stuff there. We try to be more active on social media. I know we need to do more on Twitter, and people actually can find me on Twitter too.
I'll make sure I add you before we're done here. The website is Esoterica CAP, no spaces.
Yeah.
And then the LinkedIn, all the other stuff. We'll make sure we have links in that in the episode description so everybody can find that easily.
And check out their ETF WUGI.
5G in Chinese.
5G, yeah. That makes it easy, Kyle. Good.
I assume the Wu is 5.
Yeah, that's very true.
Okay. So I learned 2 words today, or at least a word on a letter.
There you go. Baby steps.
Right. Well, Bruce, we're really happy to have you with us. I'm glad you made time and were able to.
Thank you for having me, guys. I apologize for the internet.
Oh, no, it's no problem at all. Hopefully we can get some more people from your team on. I know we were working with Wendy to try to get the other fella, the
Young.
Yeah.
Semiconductors expert. Yes.
Young used to work at Alliance Bernstein with me, and he's covering the global semi, like 10 years, and he has a lot of things to offer, I think. And if you guys happen to run a semi overview or podcast, and I think he's the right guy. And,
I think that'd be a great one to do.
Yeah, both in US and Asia, China. And really, see like how things are going on 2 ends, and I think that's a lot of things going on, and it would be helpful. We also have a China policy analyst.
Oh,
he actually just graduated this year from Harvard Kennedy School, and based in Boston right now. And we have done a lot of China policy research, and those are the things we could contribute as well. Yeah.
Well, before you run off, then maybe we should ask you, what are your thoughts on the threats of the delisting happening, potential delisting of the Chinese stocks from the U.S. markets? Do you think that will actually happen, or?
Hold on, let me get my popcorn.
Well, it really depends on this auditing stuff, and I think 2 countries are working on it, but we just don't know how the progress is. But one thing I wanted, that's my conviction. Even delisting doesn't happen, and the Chinese firms are gonna follow the rules, come to US, get listed here. But I think the new companies coming to the market, I don't think ADR is their top choice anymore. They're gonna get more listed in Hong Kong, and so that the ADR game has changed for good. No matter how this delisting are gonna work out.
You're the second person to tell us the exact same thing.
Yeah.
Oh, well, hopefully we are right.
Yeah. But, Harold Vanderland from HSBC, he's their chief Asia equity strategist, and he was saying the same thing.
Yep.
Yeah. I think, for example, ByteDance, the parent company of the TikTok. There was a long rumor being out there for a long time. They are seeking ways to get listed, go public, and just think about how much TikTok is gonna worth, right?
Yeah.
But I don't know how they are gonna do their IPOs, and because a lot of rumors out there. But I think their primary target, or they're only allowed to get listed in Hong Kong. I wouldn't be surprised, if that's their choice. Things like that. The companies, really high growth, high quality companies. I think their primary, listed place is gonna go to Hong Kong. That's my opinion.
It would not surprise me after speaking to all the other experts who said the exact same thing.
Yep.
Not my own thoughts. I just hear everybody else saying that.
Yeah.
Well, Bruce, thank you so much for joining us. We'll let you get back to your thing. You probably get your day is ready to start now, since it's I think morning over there for you.
Yeah. Thank you, guys, and it's a lot of fun to do this with you guys.
Oh, good. Maybe next time we'll prepare a fun game for you.
There you go.
Right. Dan, you want to wrap us up?
All right, folks. Thanks for sticking around to the end. We want to thank you once again, Dr. Bruce from Esoterica Capital. And sadly, we do have to end the episode, but we will be back at you soon with another exciting adventure. Until then, happy trades.
Bye, folks.
Thank you, guys.
Two Bulls in a China Shop is an entertainment program, and all thoughts and opinions expressed in the show belong to the hosts and not of any company. They are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide entertainment about stocks in the financial industry of trading. If you make trades based on what you hear in this show, you assume all risks for those trades.
I'm your voice of confidence. We're starting a business, and it's going to be awesome and successful, and everyone will love it.
Well, I'm your voice of self-doubt, and I don't think so.
We've got amazing ideas, awesome plans, and everything will be great.
What about all the paperwork?
No problem. I've got LegalZoom.
And I've got my doubts.
Stop doubting. LegalZoom can help us start our business in a few easy steps.
Oh?
Not so full of doubt now.
All right, let's do this. But any more than a few steps, and I'm out.
LegalZoom. Now you're in business. LegalZoom is not a law firm or a substitute for an attorney.